Okay, let's unpack this. We are diving into a financial mechanism that, well, it's gaining quite a bit of global traction. It's a tool that represents one of the most fundamental inversions in retirement finance, the reverse mortgage loan, or RML. This product, it's specifically engineered, really, to address a problem we see a lot, this kind of modern crisis we sometimes call the asset-rich, cash-poor dilemma facing senior citizens.
That phrase, asset-rich, cash-poor, it just perfectly frames the challenge, doesn't it? You have millions of seniors, maybe in Mumbai, maybe Delhi, or frankly anywhere in the world, who've spent their lives building equity in their home.
Right.
They hold significant wealth, tied up in that bricks and mortar, but what they need is immediate liquid cash flow, maybe for rising healthcare costs, maybe just keeping the house maintained, or simply supplementing what's often a fixed income.
And the old advice, just sell the house, downsize, I mean, that can be really tough emotionally, socially.
Exactly. Painful. RMLs offer a potential way to unlock that value, get that cash, without you having to move out.
And that's really our mission today, isn't it? To take a proper deep dive into how these work. The operational guidelines, drawing quite a bit on the Indian national frameworks as a reference point, to really demystify the whole RML mechanism.
Yeah, we need to break it down.
We need to clearly explain who it's really for, how the money actually flows, and I think crucially, detail the risks. Some of them can be a bit hidden, and the profound consequences this loan structure has for the borrower's heirs down the line.
So maybe start with the core concept. Think of an RML as a complete financial flip, an inversion of a traditional mortgage.
Right. Normally, you pay the bank.
Exactly. Normally, you borrow a chunk of money and spend 20, maybe 30 years paying the bank back, plus interest. Here, it's the other way around. You, the senior homeowner, you mortgage your house to a lender, a primary lending institution, or PLI, and the bank pays you.
The bank pays you.
Yes. And the absolutely essential feature, the cornerstone, is that for the entire time you live in that property, you are explicitly not required to make those monthly repayments of principal or interest back to the lender.
So you stay the owner, you stay living there, and the bank is effectively funding your retirement against the house. It sounds, almost like financial magic.
It does sound good, but you've got to remember that debt, it's quietly compounding in the background. Interest is adding up.
Which means understanding the fine print, the details, is absolutely vital. So let's start with who this system is actually designed for. Who qualifies?
Okay, eligibility. The criteria are very specific, and they're really designed to minimize the lender's risk over what could be a long, unpredictable period. For the Indian scheme we're referencing, the main applicant must be a senior citizen of India, generally aged above 60.
60 plus. That sets the baseline.
It does. It sets the stage for all the life expectancy calculations that underpin the loan amount.
And what about couples? Because often retirement involves two people.
That's a crucial point. The system accommodates married couples quite well. They are explicitly eligible to apply as joint borrowers. And this gives real flexibility. While one spouse has to be over 60, the minimum age for the younger spouse, it can often be reduced maybe to 55 plus, but that's usually at the lender's discretion. The PLI decides.
And why is that flexibility for the second spouse, the potentially younger one? Why is that so important?
It links directly to when the loan actually becomes due, the maturity trigger. The loan only has to be repaid when the last surviving borrower either passes away or permanently moves out of the house.
Ah, okay. So if they're joint borrowers.
Exactly. If both spouses are on the loan, even if the younger one is, say, 58, they still secure that cash flow based on the house's equity for their combined lifetimes, potentially. It dramatically reduces the risk of the surviving spouse suddenly losing access to funds just because the older primary applicant passed away first.
That makes a huge difference for security. Okay, so beyond aid, what about the property itself? It must have to meet certain standards.
Oh, definitely. The property has to jump through quite a few regulatory hoops. It must be self-acquired, so not ancestral in certain contexts, potentially. It has to be residential, only you can't run a business out of it.
No commercial use.
None. It must be located in India, obviously, for the Indian scheme, and crucially, it must be self-occupied. If you, the borrower, move out permanently, that usually triggers the loan repayment clock.
Right. We'll come back to that trigger. Any other property rules?
Yes, two more really stringent ones that speak directly to the lender's long-term risk. First, the title has to be absolutely clear, free from any existing mortgages, lands, any legal encumbrances. Clean title.
Makes sense.
Second, the property itself must have a residual life of at least 20 years.
Okay, let's pause on that. 20 years residual life. What does that practically mean?
It's the bank saying, essentially, look, we're tying up our capital against this specific physical asset for maybe 2 decades, maybe even longer. We need some assurance that the building itself won't degrade so much that its sale value drops off a cliff.
So it's mitigating the risk of the house falling apart, basically, protecting their collateral.
Precisely. It speaks directly to the inherent longevity risk they are taking on. Okay, so if you meet the criteria, how do they figure out how much money you can actually get? Monetizing the equity.
Yeah, how much cash can you unlock?
It's not just a simple percentage of what your house is worth today. It depends on three sort of dynamic factors. One is the current market value of the property, obviously.
Right.
Two is the age of the borrower, or borrowers if it's a couple. And three is the prevalent interest rate, because that rate determines how fast the debt will grow over time.
And this is where the age factor gets really, well, counterintuitive compared to normal loans, isn't it? You mentioned there's a sort of guide table showing how age affects the loan amount.
Absolutely. And it's a fascinating insight into the bank's actuarial thinking. Basically, the older you are when you take out the RML, the higher the percentage of your property's assessed value the bank is typically willing to lend.
So older is better in this context.
For getting a higher loan percentage, yes. So for example, if you're aged 60 to 65, the loan might start around, say, 40% of the assessed value. It's quite conservative.
Right.
But then it steps up. Age 66 to 70, maybe you get 50%. Age 71 to 75, perhaps 55%. And if you're over 75, it could go up to 60%. These are indicative figures. Of course, they vary.
But why? Why that structure? Normally, a lender prefers a younger borrower with more earning years ahead.
Because here, the fundamental risk dynamic is flipped. The lender isn't worried about you repaying month by month. They're carrying the cost of interest capitalization. The debt just grows and grows until the loan matures, which is usually when the borrower passes away or moves out.
So an older borrower means, statistically.
A shorter time horizon for that debt to accumulate. The lender is managing longevity risk. By offering a higher percentage to older people, they're recognizing the statistically shorter life expectancy. Fewer years for compounded interest to potentially eat up all the equity.
They want to ensure there's still some equity left at the end, ideally.
Exactly. They often want to maintain a certain buffer, maybe ensuring the loan-to-value ratio stays below a certain threshold, like, say, keeping at least 10% equity for the borrower, even after projecting decades of interest.
Okay, that makes sense, actuarially. So once that maximum loan amount, the quantum, is set, how does the senior actually get the cash? Is it just one big check?
No, and that's another strength. RMLs are designed to be flexible to meet different kinds of retirement needs.
So what are the options?
You can choose periodic payments, maybe monthly, quarterly, half-yearly, or annually. This works like a kind of supplemental pension, steady income.
Okay, regular income.
Or you could take a single lump sum withdrawal, maybe for a big one-off expense like essential home repairs, medical bills, maybe helping with a child's wedding, that sort of thing.
A big chunk up front.
Yes. Or another option is a committed line of credit, like a credit card almost, but secured by the house. You only draw down funds as and when you need them.
And that would minimize the interest accruing. Right, because you only pay interest on what you've actually drawn.
Exactly. Lower interest burden if you don't need all the cash immediately. And many borrowers actually choose a combination, maybe a small lump sum up front, plus regular monthly payments.
Seems very flexible. But are there strings attached? Can you use the money for anything? A round-the-world cruise. Starting a business.
No, that's where the restrictions come in. The guidelines are usually very clear about the intended end use of the funds.
Okay, what's allowed?
Things like supplementing your regular income, covering necessary medical costs, paying for upgradation or renovation of the mortgaged property, or even repaying an existing loan you might have on that same property. Basically, things related to living expenses and maintaining the asset.
And what's definitely not allowed?
Speculative investments, playing the stock market, for example, any kind of trading purposes, or funding general business ventures. That's strictly prohibited. The RML is meant for life security and consumption needs in retirement, not as a source of venture capital using the family home.
Got it. Security, not speculation. Now, what about the loan term? You mentioned payments might go on for 15 or 20 years.
Right. There's sometimes variation in the policy documents here. Some National Housing Bank references mention a maximum payment period of 20 years. Some specific operational guidelines might say 15 years.
But that's just the period they pay out the money.
Yes, that's the maximum duration over which the lender will disburse funds to the borrower under a periodic payment plan. But the loan itself, the debt, it continues to exist and accrue interest until it matures due to death or the borrower permanently moving out, which could happen much sooner than 20 years or potentially much later.
So the payments might stop after 20 years, but the loan is still active.
Correct. And the risk profile changes over that long period. Which brings us to another key requirement: ongoing property revaluation.
They revalue the house during the loan. How often?
Yes, they have to. The property must be revalued at least once every 5 years. This isn't optional, it's mandatory.
And what happens based on that revaluation? Does it change the payments?
It can. The lender looks at whether the property value has gone up or down significantly. If it's increased a lot, the bank might, and this is usually at their discretion, decide to increase the total loan amount available or maybe increase the size of future payments to the borrower.
Assuming the loan-to-value ratio still looks okay.
Exactly, provided it stays within their risk limits. But conversely, and this is important, if the property value has dropped substantially, the lender might actually pause or halt any further disbursements.
Why would they do that?
To prevent the total loan balance, the principal, plus all that accumulating interest from growing dangerously close to or even exceeding the property's now lower value. It's a way to protect the viability of the non-recourse guarantee, which we should probably talk about next.
Yes, let's move on to the safeguards.
Yeah.
Because that non-recourse guarantee sounds like the absolute bedrock protection for the borrower.
It absolutely is. It's the fundamental protection. You might also hear it called the no negative equity guarantee. Every RML product is expected, usually mandated, to carry this clear guarantee.
Okay, spell out exactly what it means in practice.
It means that the borrower, or crucially their estate after they pass away, will never owe the lender more than the net realizable value of their property when the loan is finally settled.
Never owe more than the house is worth.
Correct. Provided, of course, that the borrower has stuck to all the terms and conditions of the loan agreement, like paying taxes, keeping the place insured, etc. The lender's claim, their recourse, is strictly limited only to the mortgage property itself. Nothing else.
So the debt can't spill over onto other assets, like savings, investments, maybe another property?
No, it cannot. And very importantly, it cannot be passed on as a personal debt to the heirs. They don't inherit the debt, only the situation regarding the property.
That is a massive protection. Think about market crashes.
Exactly. Imagine a worst-case scenario. Maybe the loan runs for 25 years, interest compounds like crazy, and at the same time, the local property market tanks. The total loan balance might have ballooned to, say, 1 crore rupees. But the home, when appraised at settlement, is only worth 75 lakhs. If the heirs decide they can't or don't want to keep it and they let the bank sell it, the maximum the bank can recover is that 75 lakhs from the sale.
And the shortfall, the extra 25 lakhs of debt.
The bank absorbs it. Or rather, the insurance that typically backs these loans absorbs it. The family is protected from that negative equity. It removes a huge potential financial risk.
That protection against market volatility must make a huge difference for people considering this. Now, you mentioned favorable tax implications earlier, particularly in the Indian context.
Yes, this was a key part of making the scheme attractive when it was formally introduced following the 2007-08 union budget. The tax treatment is exceptionally good.
How so?
Any amount the senior citizen receives as a loan payout, whether it's that big lump sum or the regular monthly payments, it is explicitly not included in their total taxable income under the Income Tax Act.
Not counted as income at all.
No. It's treated as a capital receipt, basically an advance against the home's value, and therefore it's entirely exempt from income tax.
Wow. That's a huge benefit, isn't it? Especially for seniors on fixed incomes.
Massive. If you're relying on these payments to supplement a pension or savings income, which might already be taxed, getting the RML payments tax-free means you maximize the actual cash benefit you receive. It stops the payments themselves pushing you into a higher tax bracket.
That's very clever policy design.
Yeah.
Any other tax benefits?
Yes, another subtle but important point. The initial act of actually taking out the RML, mortgaging the property, that specific transaction is not considered a transfer under the Income Tax Act.
Meaning?
Meaning it doesn't immediately trigger any liability for capital gains tax right when you sign the loan papers.
Okay, so you defer the capital gains issue.
Exactly. You only potentially become liable for capital gains tax much later, at the point of alienation, which basically means when the property is finally sold to settle the debt, either by the heirs or by the lender. So you defer that tax burden throughout your lifetime while living in the home.
That provides a lot of breathing room. And any other tax breaks? GST, maybe?
Yes. To further lower the costs, the various services related to providing RMLs by the banks or the housing finance companies, things like processing fees, administration charges, they are also exempt from the goods and services tax, GST.
So, multiple layers of tax relief. It seems designed to be financially very efficient for the borrower during their lifetime.
It is, but accessing it isn't free. We need to talk about the administrative side and the costs involved.
Right. Who offers these loans, and what are the setup costs like?
Okay, the lenders, the PLIs, are typically scheduled banks or housing finance companies, HFCs, that are registered with the National Housing Bank, NHB. It's important to note they have discretion. They aren't required to offer RMLs, though many major ones do.
And the costs? You hinted they might be higher than normal mortgages?
They often are, yes. Because RMLs are inherently more complex products, they require a lot more upfront work from the lender, detailed counseling, multiple valuations, legal checks, managing that long-term risk profile.
So what kind of fees should borrowers expect?
You should be prepared for potentially substantial upfront charges. These can include origination fees, appraisal fees, often needing more than one appraisal inspection fees, title examination costs, various legal charges, and stamp duty on the mortgage deed.
Any idea of the scale?
Our sources suggest these combined fees can sometimes be capped, perhaps around 1% of the total loan amount, or maybe a fixed charge like, say, 10,000 rupees plus GST, often whichever is higher. A key point is these costs are frequently financed into the loan itself.
Meaning you borrow the money to pay the fees.
Correct, which means those costs start accumulating interest right from day one, adding to the overall debt balance.
Okay, that's important to factor in. But are there protections if someone signs up and then immediately regrets it? Cold feet?
Yes, there's a very important consumer protection feature, often called the right to rescission or a cooling off period.
How does that work?
The senior citizen borrower must be given a specific short window, typically up to 3 business days, after they've signed all the final loan documents, during which they can cancel the entire transaction. No questions asked.
3 days to change your mind.
Exactly. It's crucial. It gives the senior, who might have felt a bit pressured or perhaps didn't fully grasp all the terms, a chance to step back, review everything calmly, maybe discuss it with family or an independent advisor before they're fully locked in.
And if they cancel within those 3 days?
They just have to repay any small amount of the loan that might have already been dispersed, perhaps an initial small draw. But the lender might, often at their discretion, waive any interest or charges that technically accrued during those few days.
That seems fair. Now, flip side. What if things go well? Maybe the borrower gets an unexpected inheritance or, I don't know, wins the lottery. Can they pay the loan off early?
Absolutely. And this is another key protection. The borrower has the option to prepay the entire outstanding loan balance at any time during the loan term.
Without penalty, because prepayment penalties are common elsewhere.
Correct. Without any prepayment levy, penalty, or charge. This is usually mandated. It's a massive advantage. Since the debt is constantly growing with interest, having the freedom to just wipe it out if you suddenly have the means without being penalized for doing so is really valuable.
Okay, so strong protections on cancellation and prepayment. But now we need to get into the really critical risk area, the default triggers.
Yes, this is probably the most misunderstood part.
We established the paradox. You don't make monthly principal and interest payments. So how on earth can you default on a loan you're not required to pay back month to month?
The answer lies in the fact that you are still the owner of the property. And ownership comes with ongoing responsibilities and costs, completely separate from the loan repayment itself.
What kind of costs?
The big ones are paying your property taxes to the local municipality on time, keeping the property adequately maintained and in good repair. You can't just let it fall apart, and maintaining sufficient homeowners insurance, typically covering things like fire, flood, other potential calamities.
So defaulting on those obligations is what triggers a loan default.
Precisely. And the data, particularly from large international studies like those looking at the U.S. HECM program, that's the big government-backed reverse mortgage scheme there, this data is really revealing.
And what does it show? I mean, HECM is U.S.-based, but the principles likely apply anywhere, right?
Absolutely. The behavioral risks are universal. The research shows that a significant number, nearly 1 in 10 reverse mortgages in some cohorts, have ended in default. And the overwhelming #1 leading cause.
Not fraud, not something complex.
No. Simply the failure to pay those ongoing property taxes or the homeowner's insurance premiums, that's the unexpected Achilles heel of the whole thing. The monkey on the back, as the source material put it.
So if you fall behind on your property taxes, even though you're receiving payments from the bank,
The loan agreement, the covenants you signed, typically state that the entire outstanding loan balance, principal plus all accumulated interest, immediately becomes due and payable. That's the default trigger.
wow. Okay, so what are the main triggers listed in these loan agreements? Failure to pay taxes and insurance.
Yes. Also, failure to maintain or repair the property. If the lender inspects and finds it's falling into serious disrepair, that can be a default because it jeopardizes the value of their collateral.
Okay, what else?
Occupancy is another big one. If the borrower permanently moves out of the home, and permanently is often defined as not living there continuously for a period of, say, 1 year, that triggers the loan becoming due.
That's hugely important for seniors who might need to move into assisted living or long-term care, or maybe move in with family.
Critical consideration. Other triggers include things like the borrower declaring bankruptcy, or if they donate the property or simply abandon it, or if they try to create a further encumbrance on the property.
What does that mean? Further encumbrance.
Like trying to take out a second mortgage or another loan against the house without the RML lender's permission, or adding someone else to the property title, or even renting out the entire house, sometimes even part of it, depending on the contract. Anything that potentially weakens the RML lender's first claim on the property value.
And obviously outright fraud or lying on the application.
Of course, any proven fraud or material misrepresentation discovered later is almost always an immediate default event.
Those HECM studies you mentioned, did they identify who is most likely to run into trouble with these non-loan payments? Are there predictors?
Yes, they did. The research dug into factors that significantly increase the risk of these tax and insurance defaults. They ranked 6 key factors.
Okay, what was number one?
The single highest predictive factor was directly related to past financial behavior, credit scores. Specifically, FICO scores in the U.S. context, which measure creditworthiness.
But wait, why does a credit score matter if you're not making monthly loan payments? That seems odd.
It does seem odd at first glance, but the rationale is that your credit score reflects your history of managing all your financial obligations, not just loans. It's seen as a proxy for general financial discipline and reliability.
Ah, so someone with a low score might be more likely to struggle with budgeting for taxes and insurance, too.
Exactly. The data was stark. Just raising the minimum required FICO score to 580 was predicted to cut the default risk by 37%. And for every 100-point increase in the score, the default risk dropped by about 2.3 percentage points. It signals underlying financial stability or lack thereof.
Okay, credit score is number one. What else predicted higher risk?
Indicators of recent or current financial distress. For instance, being 2 or more months behind on payments for an existing mortgage at the time you apply for the RML. That correlated with a 20% higher default risk on the RML later.
Suggests a pattern of difficulty.
Yes. Similarly, having prior tax liens on your record increased the default risk by nearly 16%. Again, a clear flag for struggling with those essential household costs.
Interesting. What else?
How the loan money was used initially also played a role. The research found that taking a larger initial withdrawal, a bigger lump sum in that first month, was linked to higher default risk. A 10% increase in that first month draw corresponded to about an 8% increase in default likelihood.
Why would that be?
The thinking is that applicants needing the absolute maximum cash right away are often the most financially stressed to begin with. They likely have less cushion, fewer reserves to handle unexpected costs, or even just manage the regular tax and insurance bills down the line.
Makes sense. Any other factors?
Yes, 2 more. High property taxes relative to income was a factor, obviously. The bigger that fixed bill, the harder it is to pay if income is tight. And finally, liquidity. Not having access to other forms of credit, like a revolving line of credit, increased the default likelihood by about 22%. Less flexibility to cover shortfalls.
So these factors paint a pretty clear picture of who might be at higher risk. Did the research suggest ways to reduce this risk effectively?
Yes, and this led to what's become a really crucial policy recommendation, now widely adopted internationally as a best practice for managing RML risk.
Okay, what's the solution?
The single most effective policy identified was requiring certain riskier applicants, specifically those flagged by things like low credit scores or those prior defaults or Lennons, to set aside funds in a dedicated escrow account right at the start, when the loan is originated.
An escrow account. like you have with a normal mortgage sometimes.
Exactly like that. The lender essentially estimates the annual cost of property taxes and homeowners insurance, collects a portion of that upfront from the loan proceeds, puts it into this separate account, and then pays those bills directly on the borrower's behalf when they become due.
So it takes the responsibility off the borrower's shoulders.
Precisely. It shifts from hoping the borrower will manage it to the lender ensuring it gets paid. It moves from prediction to direct management for those deemed high risk.
And how effective was this predicted to be?
Remarkably effective. The study estimated that implementing this mandatory set-aside escrow for the higher risk group would slash the overall default risk across the program by 44%.
44% reduction. That's huge. Did it drastically reduce who could get a loan?
That's the other impressive part. It was predicted to reduce the overall number of people qualifying for the program by only about 4%.
Okay.
So a small tweak targeted at the riskiest segment delivers a massive improvement in stability without unduly locking out too many seniors who need the help. It's seen as a near-perfect policy intervention.
A targeted solution with big impact.
Yeah.
And the lender has other ways to protect the asset too, right?
Yeah.
Like checking the property condition.
Yes, the loan agreement typically gives the lender the right to inspect the property periodically. If they find the borrower is really neglecting maintenance, letting the place deteriorate significantly, they usually have the right to step in. They might use funds from the available RML credit line or future planned disbursements to hire contractors to carry out necessary repairs or maintenance. They do this to protect the value of their collateral, the house.
Okay, so risk mitigation is key. Now let's move to the end game. What happens when the loan finally matures?
Right. The loan ultimately has to be settled. That crucial moment arrives typically when the last surviving borrower either passes away or when they permanently move out of the home, remembering that definition of usually not living there continuously for a year.
And this is often a really difficult time emotionally for the family, the heirs.
Immensely difficult. You're dealing with grief, and suddenly you're facing immediate financial pressure and decisions about the family home. The responsibility to sort out the RML debt falls squarely onto the heirs or the estate.
But just to reiterate that key protection,
Yeah.
the debt itself doesn't become their personal liability, right?
Correct. We must stress that again. Thanks to the non-recourse guarantee, the heirs don't personally owe the money. Their own assets are safe. But they do inherit the responsibility to manage the property and settle the loan against the value of that property.
And they have to act fast.
Yes, the timelines are usually quite tight. Lenders typically require the heirs to notify them of their intentions within a short window, maybe just 30 days after the loan becomes due. And then they generally have a limited period, often around 6 months, though extensions are sometimes possible to actually repay the debt or sell the home.
So what are the basic choices they face, the options for the heirs?
Broadly speaking, they have 3 main paths they can take.
Okay, option 1.
Keep the property. If the heirs want to retain the family home, maybe for sentimental reasons or because one of them wants to live there, they have to step up and pay off the entire outstanding RML balance. That includes all the principal paid out over the years, plus all the interest that is accumulated. Pay that, and the mortgage is released.
Which sounds like it could be a very large sum of money.
It often is, especially if the loan ran for many years. This is usually the most financially challenging option for heirs. They need to find significant liquid funds quickly. Often it means they have to get new financing themselves, maybe a traditional mortgage or a loan against property, using the home as collateral again just to pay off the RML.
And if there isn't much equity left, they might struggle to get that new loan.
Exactly. That's a real risk.
Okay, so keeping it can be tough. Option 2.
Sell the property. This is often the most common route. The heirs take responsibility for selling the house on the open market. They use the sale proceeds to pay off the RML debt, the full balance owed. If there's any money left over after settling the debt and sale costs,
The surplus equity.
that surplus equity belongs to the heirs or the estate. The lender is generally required to give them a reasonable time frame to manage the sale, maybe up to 6 months, perhaps longer with extensions, before they would initiate foreclosure.
Okay, sell and keep the difference, if any. What's option 3?
Surrender the property. If the debt owed is more than the house is worth, or if the heirs simply have no interest in keeping or selling the property, they can essentially hand the keys back to the lender.
Just walk away.
Effectively, yes. They allow the lender to proceed with foreclosure, or perhaps the lender will arrange a sale themselves, like a short sale. The lender recovers whatever they can from the property's value, and because of the non-recourse guarantee, even if the sale proceeds don't cover the full debt, the heirs owe nothing further. They walk away debt-free, having lost only whatever residual equity might have theoretically remained.
That non-recourse feature is critical at every stage. Now, you mentioned international standards. There's a specific rule in the U.S. HECM program, the 95% rule, that acts as an important benchmark for consumer protection when heirs want to keep the home, especially if the market has fallen.
Yes, the 95% rule. This is a really valuable protection, often tied to the mortgage insurance that backs these loans. It comes into play specifically in situations where the total loan balance has grown to be more than the home's current appraised market value at the time of settlement.
So when there's negative equity.
Exactly. If the heirs still want to keep the property in that situation, this rule provides a cap on what they have to pay.
How does it work?
It states that the heirs only have to pay the lesser of two amounts, either the full outstanding loan balance or 95% of the home's current appraised value.
Whichever is lower.
Whichever is lower, it essentially caps the cost of keeping the home at just below its current market worth, even if the debt is technically higher.
Let's use that example from the notes to make it concrete. Say the debt is $320,000, but the house is now only worth $280,000.
Right. If the heirs had to pay the full $320,000 debt to keep a $280,000 house, they'd be immediately $40,000 underwater. It wouldn't make sense.
But under the 95% rule,
They calculate 95% of the current appraised value, $280,000. That comes out to $266,000. Since $266,000 is less than the $320,000 debt, they only have to pay $266,000 to satisfy the loan and keep the house.
and the difference, the gap between the $320,000 owed and the $266,000 paid.
That's typically covered by the mortgage insurance associated with the RML program. The insurer makes the lender whole for that difference.
That is a remarkable layer of protection for the heirs. It prevents them being penalized by a market downturn or just years of interest piling up beyond the home's value. Gives the original borrower peace of mind too, presumably?
Absolutely. Knowing your loved ones won't face that specific kind of impossible situation provides essential reassurance when contemplating an RML.
Yes, lenders need certainty that the property they've been funding against for years will actually be available for recovery when the time comes. Disputes with heirs can be messy and costly.
So how do they try to prevent that? One common measure, particularly noted in the Indian guidelines, is that the lender may require the borrower, at the time of taking the loan, to execute a registered will.
A formal will.
Yes, and this will serves as a protective measure for the bank. It should clearly state that the specific property is mortgaged under the RML scheme, and that upon the borrower's death, it is subject to the lender's right to recover the loan amount, unless the heirs choose to step in and discharge the debt in full themselves.
So it puts everyone on notice, legally.
Exactly. It aims to prevent a situation where heirs might later try to claim the property was left to them free and clear, ignoring the RML. It clarifies the order of claims. The mortgage gets settled first. It reinforces the need for heirs to communicate promptly with the lender and decide which of those three options, keep, sell, or surrender, they intend to pursue.
Right. It streamlines the process at a difficult time. Okay, let's try and synthesize all of this.
It's been quite a deep dive, hasn't it? We've seen the RML emerge as this really nuanced financial instrument. On one hand, it can be an incredibly valuable lifeline for seniors.
Yeah, providing that crucial cash flow, often tax-exempt, which is huge. And with smart policies like the escrow, accounts for taxes and insurance, it can even offer protection against some of the key default risks.
Definitely. But on the other hand, we've consistently hit this fundamental trade-off. Taking out an RML fundamentally changes how you should view your primary residence. It shifts it from being primarily an asset to maximize for inheritance,
To being a source of funding for your own consumption and security during retirement. The interest keeps accumulating, steadily eating into the equity that might eventually pass to the next generation.
We saw the tax benefits maximize the upside for the borrower now, and that non-recourse guarantee protects the family from personal debt liability later. But the research is also clear. The risk of losing the home through foreclosure, even without making monthly loan payments, is very real if those other obligations, maintenance, taxes, insurance, aren't met.
You are essentially exchanging maximum potential future equity for guaranteed present liquidity and security. It's a powerful bargain, but one with real consequences.
So, maybe we leave you, the listener, with this final thought to mull over. The decision to take out a reverse mortgage, it really boils down to a high-stakes trade-off played out over potentially decades. You gain guaranteed financial flexibility, security, perhaps peace of mind in your present retirement, the very years you might need it most. But the cost is weighed against maximizing the financial legacy, the equity you pass on to your heirs in the future. When you factor in those potentially high closing costs, the relentless march of compounding interest eroding the equity, and the complex, often rapid decision-making timeline forced upon your loved ones right after you're gone.
Does that immense peace of mind today from receiving those regular, maybe tax-exempt payments ultimately justify the reduced inheritance and the financial complexity placed on your family tomorrow?
The true value proposition of an RML, I think, depends entirely on whose financial security the borrower ultimately prioritizes. Their own, right now, or their families, down the road. It's a deeply personal calculation.